Oh boy, we got to cover this one. Welcome back to Strongman Personal Finance. Trump Media and Technology Group Corporation, DJT. Truth Social, the social media platform for the right wing, for the conservative man. That's going to take down the liberal social media platforms. Donald Trump is our hero and our savior, and there is nothing better to invest in than this company, right? Now, I voted for Trump in the last election, and of course he lost. But that doesn't mean I'm a massively biased clown that's always going to shill for Trump in all of his business ventures. And this, ladies and gentlemen, is a terrible long-term investment. I'm just going to say it up front. You want to get mad and call me a liberal? You're a liberal plant, bro. You can go ahead and do that. But I'm going to tell you right off the bat, I'm going to prove to you that investing in DJT is gambling, and this is a fundamentally worthless company that will probably lose you massive amounts of money in the long run. Now, I like to look at financial statements, but first we're going to see what this company is all about. So DJT is basically Truth Social. I have an account. I don't go on here, but it's basically the X or Twitter of Trump and the right wing. If you think Twitter's liberal and you don't like real social media, you could sign up for Truth Social and you have your own little conservative Twitter. How does this platform make money? Well, they sell advertisements like this thing right here. Toilet paper roll under seat. Put a toilet paper roll under the toilet seat at night if alone. Here's why. An ad by Life Hack Guru. So DJT, Truth Social, that's how they make money. You know, somebody wants to advertise, they pay Truth Social and the ad goes up. Like this amazing ad right here. But you can clearly see it's just a Twitter. That's basically all it is. It's a Twitter for the right wing. Wow, very innovative. And remember, Twitter ain't doing so well itself. But I like to look at financial statements. I like to look at numbers. So let's go ahead and dive into their offering statement, their S1, where the SPAC merger was consummated. Now on here, this is the funniest thing I ever read. TMTG, this is like the name of the company, therefore aspires to build a media and technology powerhouse to rival the liberal media consortium and promote free expression. TMTG was founded to fight back against big tech, only the largest companies in the world, Meta, Instagram and Threads, X, Twitter, Netflix, Alphabet, Google, and Amazon. Yeah, you're going to take those out, Donald. That may curtail debate in America and censor voices that contradict their woke ideology. Okay? So we're fighting back against big tech, those meanie butt poo-poo heads that are censoring free speech. Well, how well is this fight going? How successful is Truth Social? Well, according to their S1, Truth Social has experienced substantial growth from 0 users in 2022 to an aggregate of approximately 9 million signups. And look what they're going through, iOS and Android. I'm sorry. So it's an app you can download through iOS and Android. Big tech, by the way. And but they're fighting against big tech, trust me. But it's had 9 million signups. Now, that seems like a big number, right? 9 million people signed up. Well, let's look at some of the biggest social media platforms in the world. We got Facebook. That's got 3 billion users. YouTube, which we're on right now, 2.5 billion. WhatsApp, also owned by Meta Magenta, 2 billion. Instagram, owned by Meta Magenta, 2 billion. And on and on and on and on. Truth Social has 9 million signups. Facebook has 3 billion. Oh, we're going to take out big tech. But you may still be questioning my motives here, okay? What is my real motive for crapping on this company? I mean, if it was profitable, maybe it'd be a good investment, potentially. Depends how much you pay for it. But let's go ahead and read some interesting things. So I went down and I read the Auditor's Report, which I know none of you read because, it has words and stuff. But I noticed a very crucial line here. Substantial doubt about the company's ability to continue as a going concern. Now, as an accountant myself who does taxes and works in the, private accounting industry, pin comment below if you want me to do your taxes, by the way. When I see this, it makes me crap my pants. The accompanying financial statements have been, this is the auditors, they're saying this, have been prepared, assuming the company will continue as a going concern. That means you're assuming the company is going to continue into perpetuity. It's not going to dissolve. As discussed in Note 2 to the financial statements, the company's operating losses raise substantial doubt about its ability to continue as a going concern. That means auditors basically saying, we think this company's going to go bankrupt. There's a lot of doubt. This company's probably going to go under. The financial statements do not include any adjustments that might result from the outcome of this uncertainty. So if this company liquidated, guess what? All your assets on your balance sheet, they're probably not worth what you think they're worth. So basically the auditor, B.F. Borges, who is that, thinks that this company, has a good chance of going bust. But let's look at the numbers, okay? So first look at the balance sheet. We got December 31st, 2022 on the right, and we got December 31st, 2023 on the left. This is all their assets, liabilities, and equity for 2022 on the right, and all their assets, liabilities, and equity in 2023 on the left. This is a comparative balance sheet. Let's see what happened to cash. So cash in December 31st, 2022 was almost, what? Just in billions? $1 million. Wow, what a big company right here. I thought that was going to be in billions. Excuse me. The cash, they had $9.8 million. And if I say billion, excuse me, it's millions. $9.8 million in December 31st, 2022. That dropped to $2.5 million December 31st, 2023. They burned through almost, $7.3 million of cash in a year. Their cash pile massively depleted, okay? Accounts receivable, this is sales. Really dropping significantly. So they burned a massive amount of current assets, and they basically have no long-term assets, no big property, plant, and equipment, okay? Let's look at their debt. Current liabilities, accounts payable, and accrued expenses. Pretty significant jump there. Convertible promissory notes. $42 million of debt due within a year. Now, I don't know what they're probably convertible into stock, but they have $42 million due within a year on their balance sheet, and they have total assets of $3 million. So you have $3 million of assets, mostly cash, and you have $42 million that's due within a year. That doesn't sound too good. That sounds very bad, okay? But with the recent merger, I don't know, they probably got infused with a ton of grift cash. Derivative liability, I'm not sure what this is, but it's increased significantly. Unearned revenue. Okay, this is, I guess, revenue or payments they've received up front for ad space that they haven't delivered yet. Okay, I mean, that could be canceled at any time probably. But overall, the vast majority of their debt is due now. It's due within a year, and it's $65 million due. I'm sure they're going to, with the $3 million they had on hand, they were going to be just fine paying off $65 million. But of course, they would have just raised more money and whatever. Clownery, okay? So this company's balance sheet is god-awful. Like, it's absolutely horrible. Now, the merger probably saved them, like I said, but this is not good. We can clearly see a massive decline in cash, and I don't know where it went. Oh, wait, yes, I do, because we're going to see that in a second. Let's go look at their income statements. Here's their consolidated statement of operations. We have the full year, December 31st, 2023 on the left, and the full year for 2022 on the right. Revenue's gone up pretty significantly. It's gone up from $1.4 million to $4 million. Wow, $4 million of revenue. That's a big deal for a publicly traded company. So they made $4.1 million of revenue, and they spent $9.7 million on research and development, or at least expensed it. $1.2 million in sales, $8.8 million in general and admin, for a total loss of operations of $15 million. So they generated $4.1 million of revenue, but they lost $15.9 million. Oh my God. The next line, they lost $15 million in a year just from operations. Oh, and then we have interest expense. Oh, only $40 million. Wow. This is a cash-producing machine. This is basically Facebook, bro. Change in fair value of derivative liabilities. Like I said, I'm not sure what that is, but that wasn't a major factor. But I would ignore that, basically. I would look at the core business, which is not doing well. And then on top of that, you have massive interest expense. So their profit or loss from operations before income taxes was $58 million loss. This thing is a freaking turd. Okay, this thing is burning cash like I've never seen in my life. Well, I've seen worse. This is like abysmally bad, but none of you are looking at this, of course. Okay, we got statement of stockholders deficit. That's always a good word to see, deficit. Okay, net cash used. Let's see. So they only burned $9.7 million because they had non-cash interest expense on debt. So what does that mean? That means they incurred interest expense, but they just haven't paid it yet. And that was almost $40 million of interest. At some point, they're going to have to pay that interest. Okay? So we can see this reconciliation here. We go from net income, profit and loss for the full year, December 31st, 2023, to cash used in operations. So a massive part was their interest expense, which we saw. So they expensed it and probably accrued a liability, but they just haven't paid the interest yet, but they will. And there will be cash leaving the business with that accrued interest expense at some point. But it didn't leave at this time, so they added it back. Change in fair value of derivative liability. I'm not sure what that is. But we can clearly see that they still burned almost $10 million of cash. So their balance, they're burning like $1 million. I mean, not quite. They're burning a little less than $1 million a month. And they had like, as of December 31st, 2023, they had like, I don't know, only a couple million on their balance sheet left. This is a disaster. Like they're just surviving off debt and now the SPAC merger. This company isn't making jack. $4 million of revenue? Seriously? That's a joke. That's nothing. Okay, I don't care how much this stock went up. This is like another clown. This is a literal clown stock. And if you invest in this thing, God help you. Signing off.